Hello and welcome. In today's video, I will present 10 of the most common trading mistakes and how you can avoid them. But before that, I want to make something clear. Everyone makes mistakes. No one is perfect, and that's totally fine. It's just important that you learn from your mistakes and try to avoid them in the future. I'm pretty sure that you are doing at least one of the following mistakes. So listen up. If you manage to avoid all of the following mistakes, I guarantee you that you will become a much better trader. Let's get started. The first very common trading mistake is fear of missing out, or also known as FOMO. The English Oxford Dictionary defines FOMO as anxiety that an exciting or interesting event may currently be happening elsewhere. A trader suffering under FOMO thinks that everyone is making tons of money and he is the only one missing out. Due to this, the trader often thinks that everything is a good trade. He thinks if he doesn't enter a position now, he will miss out on all the profits later on. This often leads to a lot of random trading on random assets due to random reasons. If you often are anxious about missing out, I recommend staying away from chat rooms and other social trading platforms. Usually there isn't a lot of real valuable information on these platforms anyways. Most of it is just meaningless noise. FOMO often leads to another common trading mistake, namely overtrading. Especially newer traders make this mistake all the time. People that overtrade often think that everything is a good setup, and therefore they trade way too often. It is important to understand that more trades does not equal more money. Even though this might sound counterintuitive, it is true. Many successful traders have made most of their profits from a few very good trades. So focus on the best setups only. And if you're bored, just stay away from the markets. Otherwise you will just trade out of boredom and not because the setups actually are good. Now let us move on to mistake 3. Mistake 3 is being stubborn and not admitting losses. Somehow, one of the hardest sentences to say for traders is, "I am wrong." Most traders just don't want to admit that they're wrong. But sadly, it is necessary to do so if you want to become a successful trader. As I said before, no one is perfect, and therefore no one will win 100% in trading. You will always have losses, but it's so damn important to keep these losses small. If you win 60% of the time, but your losses are always double the size of your profits, you won't make money. I'm not saying that you should cut losses as soon as a trade goes against you, but I am saying if it's painfully obvious that you're losing, then just cut the loss. Don't try to rationalize why your trade could still work in your favor, just cut the loss. Admitting being wrong is one of the most important skills that every successful trader has. I always recommend setting a max loss goal before you enter a trade, and as soon as that goal is reached, just cut the loss. You could also use automated orders like stop losses. The next trading mistake goes hand in hand with the previous one. The fourth trading mistake is not taking profits. A common saying is, cut your losses short and let the winners run. Even though this might sound good on paper, it isn't always applicable to trading. It is a good idea to cut your losses short, but you shouldn't always let your winners run. It's very important to take profits when you have them, otherwise they will turn into losers. If you take off a winning position, it's a guaranteed profit, but if you wait, the position can still turn around and become a loser. So taking profits actually increases your probability of profit. My tip here is the same as on the previous mistake. Just set profit targets and stick to them. As soon as your profit target is reached, just take off the position. Once again, you can use automated orders to do this. The next and fifth mistake is probably one of the biggest mistakes of them all. It is not educating yourself. Trying to trade without educating yourself beforehand is just insane. No one is born as a perfect trader, just like no one is born as a perfect surgeon or a perfect pilot. Before becoming a pilot or a surgeon or anything else, you need to go to school for years, you need to study and educate yourself. Why should this be any different with trading? Why should anyone be a profitable trader without any education and preparation? So please, do yourself the favor and educate yourself before risking any hard-earned money. Otherwise, you will lose it all. The next widespread trading mistake is not having a trading plan or not sticking to it. Having a trading plan is essential for your success as a trader. Without a trading plan, you don't really know what you're doing. You should always have a concrete trading plan before opening any positions. In your trading plan, you should always have your profit target, max loss, and more. But just as important as having a trading plan is actually sticking to it. If you're not sticking to your trading plan, you might just as well trade without one. You should never listen to your emotions and deviate from your plan. Just stick to it. It's there to help you. Let's get into mistake number 7. Mistake number 7 is having no risk management. Risk management is a very important part of trading. You should always define your risk and your reward before opening a position. In stock trading, the risk to reward ratio is a very important factor as well. You shouldn't be risking 10 to make 1. Ideally, your risk should be smaller than your reward. There are many different risk management techniques, but I won't go into detail in this video. Just make sure that you're familiar with risk management. Another very common trading mistake is having the wrong position size, or going in too big. Barely anyone trades too small, but countless people trade too big. This is because most people get blinded by the potential returns. Most people think of the potential reward and don't even consider the risk. If you increase your position size, your potential reward increases as well, but so does your risk. The saying, go big or go home, does definitely not apply to trading. And if anyone tries to tell you otherwise, he has no idea what he's talking about. You should never risk more than 10% on one trade. Ideally, you should even risk less than 5%. I want to show this with a brief example. Let's say your account has $10,000 in it. Stock XYZ is currently trading for $100. You identify a support level at $90. Therefore, $90 can act as your max risk level. If XYZ's price drops below $90, you will cut losses. This means that your risk per share would be $10. As you don't want to risk more than 10% on one trade, you can't trade more than 100 shares of XYZ stock. Otherwise, you would be risking more than 10%. But like I said before, ideally you should be risking even less. But please, whatever you do, never ever risk all of your capital at once. Once in a while, you will have a losing trade, and if you risk all of your money at once, you will lose all of your money at once. So never risk this disaster. The second last mistake is getting emotional when trading. Emotions and trading don't go along. Trading requires rational thinking, and emotions really can influence your trading negatively. So always try to act mechanically and think rationally. When hard-earned money is on the line, this can be extremely difficult. Therefore, it's even more important to have a trading plan in place before you enter a trade. Furthermore, you can use alerts and automated orders to take more emotions out of your trading. The final trading mistake for this video is not tracking your progress. Keeping a trading diary is very important. If you're not tracking your mistakes, you can't avoid them in the future. Therefore, it's very important to track all your winning and, even more importantly, all your losing trades. You should then ask some questions. What went right and what didn't? What could you have done better and what couldn't you have done better? Why were the losing trades losers and why were the winning trades winners? All of these questions can be answered by keeping a trading journal and by tracking your trades. In conclusion, a trading journal allows you to learn from your mistakes and avoid them in the future. That's it for this video. Have you made any of these mistakes? Please let me know in the comment section below, and hopefully this video will help you avoid these mistakes in the future. Thanks for watching. If you enjoy content like this, make sure to subscribe.